Last month, a woman paid off her $30,000 car loan early. She thought she was being smart. Her credit score dropped 60 points the next day. Today I'm showing you exactly how credit scores actually work, why paying off debt can hurt you, and what to do instead to protect yourself. First, you need to understand one thing. Credit scores were not built to help you. They were built to help banks figure out how much money they can make from you. Think about it. If you pay off all your debt and never borrow again, how does the bank make money from you? They don't. So why would they reward that behavior? Your credit score is actually a profit score for banks. The higher your score, the more likely you are to borrow money and pay it back with interest. Here's where it gets ugly. Credit bureaus changed something called the credit mix formula. Credit mix means having different types of loans at the same time. Car loan, credit card, mortgage. The formula now weighs credit mix heavier than before. This means if you pay off your only car loan, you lose an entire category. Your score drops automatically, even though you did good. Let me show you real numbers. Before the change, credit mix was maybe 10% of your score. Now some models weigh it up to 20%. That's double the damage when you lose a category. Here's the math. You had a 750 credit score. You paid off your car loan like a responsible adult. Your credit mix went from 3 types to 2 types. Score drops to 690. Now you might be thinking, so what? It's just a number. Wrong. That 60-point drop could cost you tens of thousands of dollars on your next mortgage. On a $400,000 mortgage, the difference between a 690 score and 750 score is about $120 more per month. For 30 years. That's $43,000 gone. $43,000 because you paid off a car early. You tried to be responsible. The system punished you. And nobody warned you this would happen. Sound fair? It's not. Now here's what the credit bureaus say. They say this change better predicts borrower behavior. Translation, they can now spot people who might stop borrowing money and mark them as risks. Think about how backward this is. In any normal world, paying off debt is proof you handle money well. In the credit score world, paying off debt is proof you might stop being profitable. Okay, so what do you actually do about this? The first thing is, don't panic. If your score already dropped, it will recover. It just takes time. Usually 6 to 12 months of normal activity. But if you're thinking about paying off a loan soon, here's strategy number 1. Before you pay it off, open a new line of credit first. Could be a simple credit card. This way, when your car loan closes, you don't lose an entire credit type. You've replaced it with new, active credit. The mix stays diverse. The score stays protected. Simple swap. Big difference. Strategy number 2. Keep your oldest credit cards open forever. Even if you don't use them. Even if they charge no annual fee. That history is pure gold for your score. Your oldest card affects something called average age of accounts. Longer history equals more trust. If you close a 15-year-old card, you just deleted 15 years of proof that you're reliable. Strategy 3. If you have to choose which debt to pay off first, pay off the newest account, not the oldest. The newest account hurts your average age the least when it closes. Strategy 4 is maybe the most important. Never max out a credit card, not even if you pay the full balance every month. The timing of when they report matters. Here's why. Credit card companies report your balance to bureaus once per month, random day. If they catch you at 90% used, that's what your score sees. Doesn't matter that you paid it off next day. The fix is simple. Keep your balance below 30% at all times. Better yet, below 10%. Pay it down twice a month if you have to. Control the snapshot. Now here's something nobody talks about. There are 2 main types of credit scores, FICO and Vantage score. The one your bank app shows you might not be the one lenders actually use. Vantage score treats paid collections better. FICO still counts them against you. Vantage score updates faster. FICO takes longer. Different scoring, different rules, different outcomes. You need to know which one your lender uses. Before you apply for a mortgage or car loan, call the lender. Ask them which score they use. Ask what the cutoffs are. Most people never do this. It's free information. Now let's talk about the credit score myth that needs to die. People say you need to carry a balance to build credit. Wrong. This is a lie banks love spreading. You build credit by using your card and paying the full balance before it's due. 0 interest paid, 0 balance carried. Score still goes up. The bank makes nothing from you. Perfect. Here's another myth. Checking your own credit score hurts your score. Nope. When you check your own score, it's called a soft inquiry. Soft inquiries are invisible. They literally don't affect anything. Check as often as you want. What does hurt your score is when a lender checks your credit. That's a hard inquiry. Too many hard inquiries in a short time looks like you're desperate for money. Space out your applications. One exception. If you're shopping for a mortgage or car loan, all inquiries within a 14-day window count as one. The system knows you're comparing rates, not desperately borrowing from everyone. Let me tell you about authorized users. This is a hack almost nobody uses. If someone you trust has perfect credit, ask them to add you as an authorized user on their oldest card.
Wow.
Their credit history on that card transfers to your report. Their 15-year-old card becomes your 15-year-old card. You didn't do anything. You just got 15 years of history for free. Warning though, this only works with people you deeply trust. If they miss payments, your score tanks. If you miss payments on that card, their score tanks. Only do this with family you trust completely. Alright, let's talk about the credit score obsession that's ruining people. Some folks avoid all debt to get the perfect score. They're missing the point entirely. Credit scores are tools, not goals. The goal isn't a perfect score. The goal is a score good enough to get you the lowest interest rates. After 760, you're getting the best rates available. Higher doesn't matter much. Use debt as a tool when it makes sense. Low interest mortgage for a home that builds equity? Yes. High interest credit card for shoes you don't need? No. Be strategic. Quick recap. Credit scores reward profitable borrowers, not responsible ones. Paying off loans can drop your score because you lose credit mix. Protect yourself by keeping diverse accounts open and using credit strategically. Your action for today. Go check how many credit accounts you have open right now. Write down each type. If you only have one type, start researching what to add before paying anything off.